Thank you for watching. Please like and subscribe to our channel.
Imagine for a second, right, that you are at this incredible lavish party. Like, the music is bumping, the drinks are flowing, everyone is having the time of their lives on the dance floor.
Yeah, sounds like a pretty good night out.
Right. But then, right in the middle of a song, you happen to glance toward the front hall, and you notice that the hosts of the party, the people who actually own the house, the ones who planned the whole event.
The ones who invited everyone in the first place.
Exactly. They are very quietly, slipping out the back door. They've grabbed their coats. They aren't saying goodbye to anyone, and they are just vanishing into the night.
That definitely changes the vibe of the room. You have to assume they know the architecture of the house better than the guests do, right?
Yeah, 100%. So, do you keep dancing, or do you start wondering if, there's a fire in the kitchen? Welcome to the deep dive.
Glad to be here for this one.
Today, we are opening up a massive data dump titled Smart Money Exodus. And, well, we are looking at the financial equivalent of the host sneaking out the back door. We're tracking over $500 million in insider stock sales.
$500 million. That's not a small number.
Not at all. So our mission today, for you listening, is to analyze this data and figure out what happens when the people running the world's largest companies suddenly start cashing out massive amounts of stock. What do they know that the rest of us don't?
Well, what's fascinating here is the synchronization. It isn't just the sheer size of the capital being moved, though obviously pulling over $500 million out of the market is, staggering.
Right.
It's the coordinated timing across vastly different sectors of the economy. The data we are looking at strongly suggests that institutional smart money is actively de-risking. They're preparing for a shift in market volatility, and they're doing it right now, right under the surface.
Yeah, to understand the scope of this, we really need to look at the most visible warning signs first. We're talking about the mega sells.
The massive liquidations.
Exactly. These massive single block sales by top executives and founders. So let's look at Broadcom. This is a massive player in the semiconductor space.
Huge player.
Yeah, their director and co-founder, Henry Samueli, just sold a staggering amount of stock. Over $250 million. $250 million in a single transaction.
And, we have to put that in context for the broader economy. Broadcom isn't just some niche tech company.
Right.
Semiconductors are the underlying plumbing for everything. Everything from smartphones to artificial intelligence data centers. They're the ultimate economic bellwether.
So when the guy who built the plumbing starts selling.
Yeah. When the co-founder of a foundational tech company decides to convert $250 million into cash, it sends a ripple effect. He has a front row seat to global supply chains and, future hardware demand.
And it isn't just tech either. You look at traditional retail, and the story is exactly the same. The Walton Family Foundation reduced its exposure to Walmart, selling, get this, nearly $197 million worth of shares. Yeah, that's the founding family of the largest physical retailer on the planet stepping back. Then you pivot over to the enterprise software space with Oracle. Their vice chairman, Jeffrey Henley, he just trimmed his position by over $63 million.
So you have a triad here, really. Semiconductors, which represent future hardware production, massive big box retail, acting as a real-time thermometer for consumer spending and inflation.
Right, the everyday consumer.
Exactly. And then enterprise software, tracking how much corporations are willing to invest in their own infrastructure. Three completely different pillars of the global economy, all experiencing massive insider liquidations simultaneously.
Okay, let's unpack this because, my instinct here is to play devil's advocate for a second.
Sure, go for it.
I look at this list and I think, well, we need to be careful about jumping straight to a panic narrative. Let's look at Henry Samueli. The guy is a billionaire. He owns a professional hockey team, for crying out loud.
The Anaheim Ducks, I think.
Right, yeah. Couldn't a massive $250 million sell-off by a tech founder just be a routine estate planning move? Or maybe he's buying a new super yacht.
It's definitely possible.
And it's literally the Walton Family Foundation making the sale. Foundations have charitable pledges to fulfill. They build museums. They fund universities. Stock-based compensation is how executives get paid, so eventually they have to sell to actually realize that wealth. Does an executive cashing out automatically mean the company is in trouble?
This raises an important question, and It is a completely valid counterpoint. You can never look at a single stock sale in a vacuum and just declare that the sky is falling.
Right, because rich people do rich people things.
Precisely. They buy real estate, they pay massive tax bills, they fund philanthropic endeavors. If we only had Henry Samueli buying a new hockey arena or, the Waltons funding a new art wing, we wouldn't even be having this conversation today.
It wouldn't be a deep dive.
Exactly. But the source data anticipates this exact skepticism. It points out the historical correlation between these specific entities selling and subsequent drops in their respective stock prices.
Oh, interesting.
Yeah. Historically, when these particular insiders move this kind of volume, the market tends to feel it shortly after. But more importantly, it's the synchronization. If it were just one isolated tax event, fine.
Right.
But seeing Broadcom's co-founder, Oracle's #2 executive, and Walmart's founding family all deciding that this specific week is the time to liquidate hundreds of millions of dollars. The statistical probability of all those independent personal finance decisions perfectly aligning by pure coincidence is, well, it's incredibly low.
So it transforms it from just personal estate planning into a real macroeconomic signal.
Exactly.
Which brings up a major logistical hurdle. If I go onto my brokerage app right now on my phone and try to sell $250 million of a single stock on the open market, I am going to crash the price before my order even finishes filling.
Oh, without a doubt.
Like the public order books on the NASDAQ or the New York Stock Exchange just don't have enough buyers sitting there waiting at that exact second to absorb that kind of massive supply. The algorithmic high-frequency traders would see my massive sell order, realize there's blood in the water, and just front-run me.
Yeah, you would experience what institutional traders call massive slippage.
Slippage.
Right. The price of the stock would literally fall out from under you as your sale processed, meaning every subsequent share you sold would be worth less than the last one.
So how are they physically doing this? If Samueli and the Waltons are moving hundreds of millions of dollars, how are they doing it without triggering an immediate panic on the public exchanges?
They utilize alternative trading systems. Specifically, they use dark pools.
Ah, dark pools. Okay, so think of a dark pool like a VIP back room at a high-stakes casino. The high rollers are at a private table, cashing out millions of dollars in chips.
That's a great way to look at it.
Yeah, but they're doing it behind velvet ropes and closed doors so they don't spook the regular players out on the main floor.
Right.
Like, when these executives trade in a dark pool, you and I don't see those trades flashing on our screens in real time.
Not at all.
The transaction is negotiated privately and only reported to the public record after the deal is already done.
That is the perfect analogy.
Hi.
Dark pools were intentionally designed for this exact purpose, to allow large institutions and ultra-high net worth individuals to trade massive blocks of shares without causing a flash crash or, tipping their hand to the public market.
Right.
And the data dump we're looking at highlights enormous block trades moving through these opaque private channels. We're seeing the Broadcom $250 million trade, the Walmart $197 million trade, and the Oracle $63 million trade, all moving through dark pools.
Wow. But the data doesn't just show the mega cap tech and retail giants using the VIP room. It zeroes in on one specific anomaly that is, honestly, genuinely startling. It's a company called KYMR. Right, ticker KYMR. It's a clinical stage biopharmaceutical company.
Yeah, and the KYMR data is where the institutional intent really becomes undeniable.
So a major biotech investment firm, BVF Partners, dumped 2 massive blocks of KYMR stock. We are talking about one block worth roughly $190 million and another worth over $168 million.
Massive volume.
It is. But it doesn't stop with just one firm. When you aggregate the dark pool data for the single biopharma company, you find that over $418 million in KYMR shares were moved privately. And that volume came from 5 different sellers.
We really need to pause and look at the mechanics of what is happening there. Moving nearly $500 million in dark pool volume for a single mid-cap biopharmaceutical company is highly irregular.
Very weird.
Biotech is an incredibly volatile, risk-on sector. Companies literally live and die by FDA trial results.
Right, so if you are holding biotech stock, you're usually looking for massive growth. You want that home run when the drug finally gets approved.
Exactly. So when you see 5 different institutional sellers using a dark pool to quietly offload $418 million of that exact stock, it signals a massive shift in risk appetite.
You don't want the home run anymore.
No, they aren't waiting for it. They want capital preservation. And because there are 5 distinct sellers using the dark pool for the same ticker, it creates a traffic jam at the secret exit. They've all independently looked at the macroeconomic environment, evaluated the risk of holding a volatile biotech asset, and decided simultaneously to prioritize cash over potential growth.
It's like they're all trying to quietly slip out the back door without alerting the others, but they end up bumping into each other in the coat room.
Precisely. And doing it through a dark pool is a deliberate strategy to ensure the public doesn't realize the smart money is abandoning ship until the lifeboats are already in the water.
Okay, so we know who is selling these major executives and massive investment firms, and we know how they are hiding it, pushing hundreds of millions through these private dark pool exchanges to avoid slippage. But the data highlights a pattern that goes beyond just a few big players taking profits. It's a phenomenon called an insider cluster.
Historically, the insider cluster is one of the most reliable bearish indicators in the entire financial world.
Yeah, and for you listening, an insider cluster is basically defined as multiple executives or directors at the exact same company selling their personal stock within days of each other.
Sometimes even on the exact same day.
Right. We touched on KYMR, where two insiders sold over $173 million combined. But the data shows this cluster effect happening everywhere. Like at Best Buy, you have Richard Schultz and another insider dropping over $32 million.
It's a lot of TVs.
Right. At Airbnb, Nathan Blatchersick and a colleague sold over $13 million. At a genetics company called Natera, two insiders dumped over $12 million. And at an environmental industrial firm called CEO, three distinct insiders liquidated shares on the exact same day.
If we connect this to the bigger picture, you have to look at the boardroom dynamics.
Yeah.
We talked earlier about how a single executive selling might just be buying a yacht or paying a tax bill.
Yeah, the devil's advocate point.
Exactly. But executives at a company don't operate in a vacuum. They sit at the same mahogany tables, they review the same internal dashboards, the same forward-looking revenue projections, the same supply chain bottlenecks, and, the same consumer credit defaults.
Here's where it gets really interesting, because the contrast is what exposes the truth. It's one thing if Airbnb's Blatchersick wants to diversify his portfolio. That's a wealthy guy making a personal financial choice.
Sure.
But let's look at CEO. This is an industrial solutions company. You have three different executives sitting in the C-suite looking at the exact same internal data regarding industrial contracts and environmental regulations. And all three of them independently decide to hit the sell button on the exact same Tuesday.
Yeah, the optics are bad.
You cannot tell me all three of them just happen to have an unexpected tax bill on the same afternoon?
The mechanism driving that behavior is entirely driven by proprietary information. They know exactly how the sausage is being made, and they're looking at internal metrics that the public won't see until the next quarterly earnings report.
They see the iceberg.
Right. When a cluster forms, it tells you that the internal data is concerning enough to trigger widespread, coordinated de-risking among the very people whose livelihoods depend on the company's success.
It's a behavioral tell.
Exactly. And the source data isn't just showing us one isolated cluster. We are seeing clusters in industrial manufacturing with CEO, retail with Best Buy, hospitality with Airbnb, and biotech with KYMR. 5 distinct sectors experiencing simultaneous insider clusters is the ultimate red flag.
It's everywhere.
It is. It suggests a broader lack of confidence in the macroeconomic environment going forward. They aren't just worried about their specific company's earnings. They're worried about the entire economy's ability to sustain current valuations.
Which naturally makes me wonder about the other side of the trade. For every seller in the market, there has to be a buyer.
Somebody is buying those shares.
Right. If the insiders are executing coordinated multi-million-dollar sell-offs, what is everyone else doing? And this is where the data reveals a divergence that is honestly a little terrifying.
It's stark.
Let's look at the insider buys. Are there any executives bucking the trend? Are any of the smart money players actually putting their own cash into their companies right now?
Well, the list of institutional buyers in this data dump is startlingly small.
It's practically non-existent. We have an energy company called PAM, where a director bought about $3.7 million, and a real estate firm, FTH, where the CFO bought about $400,000. And that's it.
That's the whole list.
That is the entirety of the buy side of the ledger for the insiders.
We really have to compare the scales here to truly understand the lack of conviction.
Let's put it in perspective for you. On the buy side, we have a real estate executive cautiously dipping his toe in with $400,000. But on the sell side, Broadcom's founder is offloading $250 million. The Walton family is pulling out nearly $200 million. That $400,000 buy is a rounding error. It wouldn't even cover the transaction fees on the dark pool trades we were just talking about.
It highlights a complete evaporation of buying pressure from the people who actually read the corporate balance sheets. But the divergence becomes truly alarming when you pivot away from the executives and look at the retail market.
Oh, man. This part is wild.
The data provides a snapshot of current market sentiment by tracking what is trending on StockTwits.
Which is a massive social media platform for everyday retail investors.
Exactly.
And the contrast is just wild. The trending tickers on StockTwits aren't safe haven assets. People aren't rushing into treasury bonds or blue chip dividend stocks. The retail market is obsessed with entirely speculative plays right now.
Pure speculation.
Yeah, we are talking about internet meme coins like PPE and XRP. We have Bitcoin trending, and we have highly volatile commodity plays like leveraged oil trackers, USO and silver mining companies like CDE and JNUG.
This is the crux of the divergence, and it's a phenomenon we see near the end of major market cycles. The data reveals what financial analysts call speculative retail froth.
Speculative retail froth. Okay, let's break down that mechanism. Why do retail investors flood into meme coins and silver miners exactly when the smart money is quietly exiting?
It really comes down to access to information and the gamification of finance. Retail investors generally don't have access to forward-looking supply chain data or private dark pool ledgers.
They don't have the VIP room access.
Exactly. So they trade on momentum, sentiment, and the fear of missing out. FOMO. When a market has been running hot for a long time, everyday investors start feeling invincible. They stop looking at fundamental valuations like price-to-earnings ratios and start looking for the next lottery ticket that might shoot to the moon overnight.
Yeah, chasing the hype.
Right. They take on maximum leverage to trade volatile commodities or crypto assets because the recent past has taught them that taking extreme risks gets rewarded.
So we have two completely different realities coexisting at the exact same moment. On one side of the room, you have everyday retail investors treating the stock market like a casino, aggressively taking massive risks on internet memes featuring cartoon frogs. And on the other side of the room, behind the velvet ropes of the dark pools, the executives who actually know what the upcoming quarterly earnings reports are going to look like are quietly taking $500 million off the table.
It is a wealth transfer in real time.
Wow.
The institutional professionals are actively selling their massive positions into the exact liquidity that the retail speculation is artificially providing. The retail traders are enthusiastically buying the very shares that the smart money is desperately trying to offload.
So what does this all mean? We've covered incredibly complex ground today, but the narrative hidden in this data is, well, it's remarkably clear. Let's synthesize the main takeaways from the smart money exodus.
Let's do it.
First, we have the sheer scale of the mega sells. Over $500 million being liquidated by foundational figures in tech, retail, and enterprise software.
The heavy hitters.
Right. Second, we uncovered the mechanics of the exit. Institutional players utilizing dark pools to quietly move massive blocks, specifically that $418 million anomaly in the biopharma space, ensuring they don't spook the public markets.
Slipping out the back door.
Exactly. Third, we explored the cluster effect. Multiple executives at companies like CEO and Best Buy independently reviewing their internal data and simultaneously deciding to head for the exits.
The ultimate bearish signal.
And finally, the massive divergence. A complete lack of insider buying paired against a retail market that is frothing over highly speculative meme coins and commodities.
When you layer all four of those metrics on top of each other, it paints a definitive picture of a market where the insiders are aggressively bracing for economic turbulence. They are securing their capital now, while the retail market is still blindly optimistic.
And that leaves you with a final thought to ponder as you evaluate your own financial strategy. We have looked at the raw data. Institutional smart money is utilizing private over-the-counter mechanisms to quietly offload hundreds of millions of dollars in shares right at the exact moment that everyday investors are enthusiastically absorbing the risk.
The insiders have already secured their lifeboats.
Right. So when the volatility that they are so clearly preparing for finally hits the broader market, who is going to be left holding the bag?
That is the $500 million question.
Think back to that incredible party we started with. The music is still playing loud, people are still dancing, but the hosts have already taken their coats, they've already slipped out the back door. Are you going to keep dancing on the main floor, completely unaware that the music is about to stop?
Time to check for the exits.
Thank you for joining us on this deep dive. Keep questioning the data, keep looking for the hidden exits, and we'll see you next time.